Oil and gas DPP investments, you get this amazing upfront deduction. Then you get this passive income stream.
It is a very easy, simple, and powerful strategy. The caveat, it's not liquid.
All right, welcome to the Tax Mastery for Solopreneurs show, brought to you by Oakenshield Tax Advisors, where we've helped solopreneurs and business owners legally save millions of dollars in taxes by following our simple 7-step tax mastery framework. I'm Sam, and I'm here with Daniel Sleep, CPA, certified tax strategist, and the founder of Oakenshield Tax Advisors. And I'm also here with Camilo Rojas, our senior tax advisor here at Oakenshield. So each week we'll show you how to stop overpaying the IRS, keep more of what you earn, and redirect those dollars into building real wealth. Quick disclaimer though, every situation is going to be a little bit different. So the advice here today that we share won't apply to everyone's situation, so just make sure to consult us personally. Today, we're going to be diving into oil and gas investments, and particularly 4 areas that we want solopreneurs to really understand. First of all, understanding what it is, the tax advantages of it, who it's right for and who it's not right for, and then how to actually implement it, what the step-by-step would be. We'll be sharing examples throughout today's episode as well. So if you guys are ready, we'll go ahead and jump in with that first one, kind of understanding what oil and gas is. Daniel, what exactly is an oil and gas DPP? Like, what does that stand for, and
Yeah.
how does it work?
Yeah, that's a good question. So oil and gas DPP, that stands for Direct Participation Program. So it's a type of investment vehicle that allows investors to directly participate in a business venture for cash flow and tax benefit purposes. So these are typically structured as partnerships. And in fact, I would say almost all of them are partnerships because they are flow throughs. And though those benefits, whether it's the income or the tax benefits, flow into your personal taxes.
Very nice. So why do high earning solopreneurs, which are usually the people we work with at Oak and Shield, why would they even consider oil and gas as a part of their strategy?
Well, part of it is obviously what pushes people to look for these things is one, they are high income earners. So by definition, they're what's considered an accredited investor because again, it's not going to be available for someone that's just making maybe 150,000 a year. It's for married filing jointly couples that make 300,000 or more for the last 2 years or have a net worth of $1 million excluding their home, their primary home residence. So if you meet either one of those parameters, then you can be an accredited investor and then qualify to do oil and gas DPP investments. The reason why I think solopreneurs are looking at that is because maybe they've already done some really cool retirement strategies. They either don't want to do real estate or already have done real estate and want to diversify their income stream more. And oil and gas DPP investments is a really good way to do that because you get this amazing upfront deduction and then you get this passive income stream for, I think, up to 10 years, depending on obviously the specific DPP investment. Not all are created equal, but you want to make sure that you're investing in a legitimate oil and gas DPP investment and one that's diversified when it comes to the wells that are going to be drilled and things of that nature.
Yeah, before we even jump into more of the tax benefits of it, I think there might be some confusion sometimes around, is this something I can invest in my brokerage? It's separate, it's a completely different thing. Is that correct?
Yeah, it's so oil and gas DVP investments, they are private investments, right? So you can't just go on your brokerage account and look up oil and gas and invest in Shell or any of these other publicly traded companies. This is specific to private domestic investment. So essentially to give you some background, someone could be like, well, why is this even a thing? It was during the Gulf War, Congress was really concerned with the potential scarcity of oil. And so they passed these laws to incentivize domestic investment in oil and gas here in the US. So you can see like every tax benefit and quote unquote loophole, if you will, is to encourage economic stimulation. So this was a way for Congress to increase and reward investors for taking a risk in their investments, because all investments have risk, right? So the other thing to be aware of is private oil and gas investments, just like any other private investment for the most part, is tends to be illiquid. Meaning if you invest 100 grand into an oil and gas DPP investment, don't
Hmm.
expect you should not be in a position or say, oh, a few months later, I changed my mind. Can I get that money back? That is not how you want to deal with this. So you want to make sure you have a reasonable amount of cash flow. And I'm not saying, oh, expect to lose it, but do not expect to get it all back in a year or less. You're going to get it back through the tax benefits, and then you're going to get it back through the income that it produces over the span of several years.
Got it. Yeah, I think that's a very important point for solopreneurs, business owners to realize is it's not just like a put it in, get the tax savings, and immediately get that investment back. You got to realize it's a longer term thing. So, Camilo, any thoughts about what we've shared so far about understanding oil and gas?
Yep. So hopefully, if you're watching this, you've gone to the previous ones and you've watched the mindset episodes that we've done. Because it comes into play into pretty much every single strategy, right? Investments versus just paying your money to the IRS. So a lot of times people will say, well, I spent this much money and you only saved me X. That's a net loss. And that's a really frustrating thing to hear because it just means you have not understood the concept that we're trying to give you here. So the first part is these are investments, right? So we're going to use a very, very simple scenario here. Let's say you're going to go ahead and invest. Okay. So let's say you will invest $100,000. It's not an insignificant amount. It is quite significant, but let's just say you have a $100,000 investment. This is, before anything else, an actual investment. What is this going to give you? Well, the first thing it's going to do is going to give you a deduction. This deduction is always going to be between 80 and 85%. At least for us historically, that's what we have seen in all of the clients where we've implemented this strategy. So what's that from 100K? That's why we're using 100s because it's nice and easy. So on the low end, you can expect an $80,000 deduction. Okay,
Which is
that's
amazing.
already $20,000 less than the 100, right? So that's a point that you can easily start to complain about something. Don't. It's actually going to get smaller than that, but it's okay. $80,000 does not mean you pay $80,000 less. That's your deduction. Okay. How much less you're going to be paying depends on your tax bracket. What is that number going to be? Well, assuming you have the 100K to invest, we're going to assume you have significant income. So you're probably at the highest tax bracket of about 37%. So your actual savings here, right? The money that you're going to be netting out of this is that you will be paying $29,600 less. These are your savings right here. Okay, you saved $29,000, $29,600. Well, then you can say, well, that's not good. I spent $100,000. No, you invested $100,000. It's your money. It's still yours. You keep it. There's nothing that money's going away. And because it isn't an investment, you will get that money back over the next 10 years. So the bulk of your money will come back in the first 3 years. Right? So you can easily expect your money to be back within 3 years. Anything after that is now going to be profit for you. So you got $29,000 in savings and you get your money back and you now have a return as well. You can call it whatever you want. You can call that a return, you can call it a profit, but you're going to be making about 1.5 to 3x your return. It depends on how well oil and gas is doing at that point. But let's say it's 1.5. You just got another $50,000. Yes, this is over time, but here's what it cost you, $100,000. to get back $100,000 and $50,000 and pay $29,000 less in taxes. This is a great strategy. It's not the best strategy out there, but it is a very easy, simple, and powerful strategy. The caveat, it's not liquid. You put that money in, it stays in there, and it gives you benefits for the next 10 years.
Yeah, no, I really like this illustration. And this is only that estimate tax savings is based on federal taxes, right? This, because it's active that first year, if you pay state income tax, you're going to be able to offset your state income tax, which is really powerful. The other thing to reiterate is your net worth really hasn't changed when you make that investment. So for example, if you put that 100,000 into oil and gas DPP investments, your net worth is the same. You have $100,000 position in an oil and gas investment. So overall, your net worth has stayed the same. Here's what's cool though, is that you just moved that your cash flow from liquid cash to intangible, let's just call it what it is, an illiquid investment, but it's still an asset on your overall net worth balance sheet, right? But what you did was you just made it more tax efficient. So not only did your net worth not change from this time period, but you also lowered your taxes. So if anything, you've increased your cash flow overall when you really think about where's that cash going, right? Well, I'm putting 100,000 in investments and I just saved myself almost 30 grand in taxes. You are definitely more optimal. But a lot, again, it's funny. I think Camilo and I were a little frustrated with a recent client where we saved him $140,000 in taxes. And I think he had it in his mind that somehow we were going to do some kind of trickery and then he wouldn't have to, he would just pay less tax without moving or investing anything. So it was one of those things where it's like, yeah, but I had to invest a lot. Okay, sir, remember your net worth, if anything, has stayed the same, if not increased because of these investments, and you're more tax optimal. Would you rather have just paid the 140,000 and just had cash? If
Well, you wouldn't have cash. You would have.
you would your net worth actually would decline by that 140,000 because you had to pay tax on it versus investing it. So you're actually worse off long term. And I would say that high income earners that are savvy with their tax efficiency, they know that difference. But it can be hard for someone that just sees, well, now I don't have that 100,000 in cash available. Sure. But in this scenario, would you have rather put that cash to an investment and have your net worth stay the same? Or would you rather keep the cash in there and pay 30 grand in taxes? Well, now your net worth just went down by 30 grand. We have clients like that are just so terrified of not having 400,000 or 500,000 in cash available, if not more, and just choose not to do anything with it. And that's where you have to look at, okay, do I have enough liquidity to do an investment like that? If you feel like you don't, then oil and gas may not be the way, but we have had other people do less amounts that still want to get a tax benefit and diversify their investments and do like 25,000 or 50,000 in oil and gas.
Right.
So
Yeah, no, really great points. And I love that we kind of pulled on the mindset of it all too. Like that's really something that's important to us and helping people understand is it's not, you're not just going to get these free amazing tax savings by just checking a box. Like there are things that you have to do and put that step forward. So let's go ahead and play devil's advocate just a little bit. I want to talk a little bit about the risk and ask you guys on a scale of 1 to 10, where would you put this strategy on the risk factor of perhaps maybe not getting that return back? Maybe that's something they talk more to the oil and gas professional about, but just in your general experience, what have you guys seen as far as risk?
Camille, I'll let you answer this.
So from all the conversations that I've had with our specialist that actually handles the investments themselves, the risk of you not getting your money back is almost non-existent. right? The risk is how big is your return going to be? And
Mm,
that's where the 1.5 comes into play. That's the low end. The 3x is the nice, great situation. There's no way. Markets go down. This has nothing to do with the market. That's another thing when people think this is buying a stock. It's not buying a stock. The
mm,
market can crash. It's not going to affect this. People need gas. People need to be able to get around. Gas tends to be a pretty stable price. Now, when the price does drop and the oil companies that we work with, they think that they're not really making a profit, they stop drilling so that they're not selling at a loss. And that's why there is as much certainty as there is with this. Now, is it guaranteed? No, there's nothing that's guaranteed. But since we've been doing this, we don't have a single client that has actually had a loss from this. So it's
nice.
pretty safe. That's
Yeah.
also why it's not a 20x return.
Right.
Right.
Yeah, it's definitely for someone that's looking to just more diversify with they may have a lot in publicly traded positions and stock in their portfolios. Maybe they do have some real estate. This is just another tier to diversify. I will say that with all, I think the other risk that you need to realize is that first year you're noted as a general partner. So there is some liability there. Now, like we've looked at the contracts and you just have to realize that first year as a general partner, whatever that liability is, and it is probably very, very minimal, but you still need to be aware of it, is that, okay, as a general partner, understand the difference in responsibility. Now, that's only for 1 year, and then you shift to a limited partner. I don't know of any other investment besides maybe a business that you were actively involved in, and then you became limited years later because you're not actively involved. Other than that, to have this treatment where the first year you're a general partner and able to take these amazing write-offs, but then the following year, when it's producing income, you're switched to a limited partner, and that income, because it's passive now, is not subject to self-employment taxes. It's
Mm,
amazing. So you get both of these amazing treatments. If you're a solopreneur and let's just say you've got W-2 and your K-1 income, the active status of being in oil and gas, those write-offs can go against that income. So it's really powerful. But to go back to the risk is, yeah, you may not get as big of a return, but part of your return is also the tax savings. So
yeah.
you need to account for that too. But I think all investment obviously has risk. If somebody's guaranteeing zero risk, then run because it's just not possible. But I do think at least the oil and gas investments that we've worked with, they're very diversified as far as more than do not invest in a DPP where they're only maybe focusing on 1 to 5 wells, right? That's bound to fail. You want someone or a operation where there's dozens, if not close to 80, I think, different wells that are in operation to ensure that there's going to be production and there's going to be income.
Ah, yeah, no, that makes sense. And actually, now that you're starting to talk on that side, this is perfect because I feel like so far we've talked about what oil and gas DPP investments are, how kind of how they work, the tax advantages of them. We've talked about who it's right for and kind of what income threshold you want to be at, right? But now I'd love to talk a little bit more as kind of our final point here is kind of the implementation or step-by-step example of, let's say a client is working with us. What process do they go through to begin implementing this strategy? Because it's not something they just do on their own, right?
I would hope not, because there's a lot of sketchy operations out there, like not reputable companies. A lot of times they don't know what they're talking about. So some of the companies we've gone through, it's just through people that are in companies that we know that have been vetted through the CTC, which is the American Institute for Certified Tax Planners or tax coaches. And so that obviously gives it a better elevated critique there and vetting process. Now, with that said, too, the reason why we like who we work with is because now we've seen the K1s, right? That flow into the personal taxes. And that's the other element. So if you have somebody that is pitching to you, for example, oh yeah, oil and gas DPP investments, and they don't really know the tax treatment, or maybe they're saying you just don't want to be pitched an actual passive investment when it doesn't meet the qualifying tax laws, right? So you want to make sure that you're going to qualify for those nice write-offs up front. And here's the other thing. You want to make sure your preparer knows what to do with it, because these are unique K1s. We just had, in fact, it was this guy we were just talking about where his preparer prepped the return. We reviewed it, and immediately I knew, okay, well, he didn't input the K1 appropriately because he's noting it as a passive investment. So, and it specifically says on the K1, general partner. And it was just because it was nothing he had ever come across. So he had to, it took him a bit, but he got it done correctly. And I told the client, I was like, that correction saved you $35,000 in tax, both on federal and state. So he had, and I would say this preparer, I've seen his other work. He's very capable. This was just a unique situation. Like this, the same client had a simple fee donation, which he noted properly. It's just realize the other sophisticated part of this is just ensuring that your tax preparer knows how to file these and report these properly, because they are unique. And then the following year, he needs to be noted as a limited partner, not general. So as long as he's following that K1 properly, he should be benefiting. And I had a conversation with another client where also did oil and gas DPP investments, and we talked about the savings there. And he was like, "Oh yeah, speaking of which, I just got a check for $4,000 from them." The other thing is knowing, okay, well, how do I get paid? Usually, you should just get it through direct deposit. I think that was what the companies we've worked with have said. Yeah, let's get you on direct deposit. But I think this guy in particular was like, just cut me a check. Some people like the tangibleness of that, but definitely a great
The
strategy.
frequency there is quarterly, right? It's a check every quarter for 10 years. That's a nice stream of cash right there.
Honestly, I would say this, Sam, is oil and gas should just be one part of your tax plan, right? It can really work amazing things. Let's just say, for example, someone wants to do a Roth conversion. They got a lot in pre-tax investments and they got some cash flow available. Let's say they have 200 grand in savings or something. If they do a conversion of 100 grand from their pre-tax income and then do maybe 100 or 120 in oil and gas, they can almost write off the entire amount, depending on the percentages that they get from the write-off. But that could really offset a Roth conversion if done properly. In tandem with that, another really good strategy is, let's say you have a lot of passive real estate investments. Well, because they're passive, it doesn't behoove you to do any cost segregation studies to accelerate the depreciation on those properties. However, if you're going to have passive income from oil and gas, all of a sudden you can accelerate the depreciation on your investments from real estate against that passive income. And hence, for a few years, depending on the depreciation, all of that, you could potentially be wiping out your passive income for a little bit. And it's not ever a one and done thing. I think we've had a few clients that say, okay, well, what more can you do? Well, if you're planning on making income for next year and the year after, you always want to have a game plan when it comes to your tax strategy. Otherwise, you're going to just pay tax, a large amount of tax again without that strategy in place.
Yeah. Sounds like it's not just a one and done strategy. It's if you pair it with other strategies, a bigger part of the broad plan, it can go a long ways. I love that. I was actually going to ask about layering this into a broader tax plan, but it sounds like that's exactly how it would work, is it's a piece of the puzzle here. Yeah, I guess if we were to just simplify it, like let's say it's someone's very first time working with a tax planner and they are interested in oil and gas, in just like a couple steps, like what would that maybe look like? Let's say I'm joining on, right? And I'm like, okay, I want to do this. Does that mean I'm meeting with another specialist on my own? Do you guys connect me with them? Like, what does that normally look like?
Yeah, from our experience, typically one or both of us will do an introduction meeting and we'll with our oil and gas specialist and just go over the oil and gas. We mainly just are listening because it's
Okay,
not
yeah,
really a thing as far as the investment is concerned. And it's in the client's hand as far as what they want to do. There is no pressure. We've had several clients that have talked to our specialists and then maybe they talk to them twice and they just say, I don't want to do it this year. And that's completely fine.
right.
We'll just say, okay, we'll let them know. And what do you want to do instead? Or, yeah, do we need to do a tax estimate? If this isn't the strategy, what are the other things? Because normally we'll have a couple of big strategies that we know is going to get them the furthest when it comes to the tax efficiency of their situation. So Camilo and I have had it's probably 50-50 where it's like we have several that they do the meeting, they absorb it, they process it, and then half of them will say, not this year, maybe next year. And the other are like, yep, let's do it. So it's a really non-pressure meeting. And I like it that way because at the end of the day, you've already paid us to do your tax planning. We're not getting a commission or anything like that from the oil and gas. It's just to find the most efficient way to diversify your wealth and mitigate your taxes.
Very good. Any final thoughts on that, Camilo?
No, just note that the door is always open. We've had a few clients where they're very excited about the opportunity with oil and gas, but for whatever reason it is, they decide to not go through with it. And the person we work with is very understanding, very professional. There's no issues. And then we do have a case where we scheduled it. It was great. Let's go. Client backed out a few months later. I was like, yeah, let's consider this again. Let's do a meeting again. Got into it. It's like, all right, yes, we're going to do this. Then backed out
Nice.
of it again. You know, it happens. It's okay. Like Daniel said, there is no pressure whatsoever. We present you with the strategies we think can have the greatest impact for you, but ultimately, whether you choose to engage in those strategies or not is up to you.
Beautifully said. Well, thank you guys, and thank you for diving deep into this today. I think people really enjoy going over these advanced strategies, so make sure you're tuning in for more episodes of not just the advanced strategies, but foundational things, the things you need to have set up first so that this all makes sense. But all in all, thank you for joining us on the Tax Mastery for Solopreneurs show, everyone. If you're looking for a list of the best tax strategies for solopreneurs, make sure to grab a free copy of the 7-Figure Solopreneurs Tax Playbook in the description below or on our website at oakenshilltax.com. We'll be back next week with another episode, but until then, as Daniel, you always like to say,
Let's save some money.
let's do it. Thank you guys very much.
Take care.